And good morning, everybody. Welcome to this special edition of Market Mornings with Benzinga and Trader TV today. Lots of news going on. For any of you that have just woken up, you're waking up to a crazy day in the market. We've had two now banks fail in the past 3 days. The banking sector taking a major hit today, as well as the entire S&P 500 as a whole. What does this mean? What happened? What's the government doing about it? And what does this mean for us going forward? And what's causing this? Lots of questions for traders, investors, and everyone. Everyone wants to know what to do. Is this something to be nervous about? Is this a sign of things to come? These are all questions that will be answered in the near future. But as of right now, we take what we have, the news that we have, and we will see its effect on the market. Right now, it's hitting the market pretty hard. So what happened? So you have two banks. It started on Friday. As some of you know, the news started Friday into over the weekend. Silicon Valley Bank went under. What does this mean, went under? Well, they basically have more debt than capital. And the government has come out today. Janet Yellen, our Treasury Secretary, has come out today and said that the government will be fully backing all depositors for Silicon Valley and Signature Bank. So normally, under normal circumstances, some of you know, anyone who has a checking account or a savings account, the FDIC has standard coverage with any registered regulated bank that covers you up to $250,000. And that's it. So if you have $5 million, you're only covered for $250,000. The government has now said that they are covering everything fully. So any amount that is in deposits is going to be covered by the government. So we don't know what that number is going to be. We don't know how bad this really is, how bad of a failure really is, but we will find out in the coming days. So let's take a look at why this happened. So for most of you that listen to my podcast and listen to the things that some of the things that I've posted and talked about, both on my podcast and some of my YouTube videos, the one number that I've been looking at in this whole inflation era that we've been in and trying to come out of it with the raising of interest rates every couple weeks and months recently, is the consumer credit number. Now, why is this so important? Well, it's important because the consumer credit number represents the amount of debt that Americans, both businesses and personal, are taking on in a given month. The number is reported every 30 days. That number is announced usually on a Thursday morning, on the third Thursday of each month, and it affects the market greatly because it shows how much debt has been added to the books by banks. Now, we've been seeing numbers in the 5-6 billion range through this entire inflationary period every month, which is significantly higher than it was pre-pandemic. I guess is the last time we can really look at what would be average normal numbers. So these numbers have been getting consistently higher. Now, banks, through this entire inflationary period, because people are spending more money, they're obviously needing higher loans, higher lines of credit. So the banks have had to loosen up to adjust to the changes in the value of the dollar and the value of currency. And these are important things when it comes to the health of our banking system. Now, when COVID first hit and everything got shut down, when Trump was still in office, the federal government fully backed the banks right off the rip. So when all that PPP money was going out and all the loans and the COVID loans were going out and everything was, when things were hitting the fan, the government was pumping money into the banking system to make sure the banking system stayed healthy to avoid a 2008 type of crisis. Now, unfortunately, what happens in those situations, and we're seeing it now, is greed takes a hold on management, upper management in a lot of these banks, and they loosened up the way they were loaning money throughout this period of time, because they were able to now take risks because more money was being spent, because consumer prices were up, because producer prices were up. The CPI and PPI numbers were up throughout the past 2 years. They kind of had to loan more money to be able to take advantage of the growing amounts of money being spent. Now, the downside to that is that it is going to significantly increase the amount of debt they have. So if we ever go into a recession, they're going to be holding the bag, so to speak. Now, a lot of stock analysts and traders like myself look at the CPI and PPI numbers very significantly when it comes to gauging the future of the market. I like to look at that consumer credit number because I feel like it's really kind of shown to me that inflation has not been pulling back at all, because the consumer credit number has been continuing to increase. So what that means is, even though the inflation has not been pulling back and they've been continuing to raise interest rates, they've still been lending the same amount of money with hopes that it will continue to get paid back. And that is what you are seeing, and that is what has caused these two banks to fail. They took on way too much risk in the past couple years. They had way too much debt, and now they have failed because their debt vastly exceeds the amount of capital they have. So they've had to shut it down. Now the government has to bail them out. Now, is this a sign of things to come for the future for other banks? That we are yet to see. But some interesting things have happened in the past couple weeks that I would like to take note of. Most importantly, a week and a half ago, about a week before this, and we discussed this on my podcast, Janet Yellen came out, our Treasury Secretary came out and said that inflation is not getting any better with the raising of interest rates, and that the federal government and the Fed itself needs to become more aggressive in their attack against inflation. So what that means is they are now planning, well, at the time, we're planning on continuing to more aggressively raise interest rates even higher, which is not good. And that is why we saw the market really kind of fall apart last week and never really come back from it. Now, at the end of this, a week later, we see two large banks fail. So the question is this the beginning of what could possibly be a recession? And the answer to that is absolutely, because this typically, in any sort of recession, if you look back in history, the banking system's always going to be the first place that you're going to see weakness in a recession or a recessionary period of time. So with that all being said, I do believe we have to be very careful going forward in the market, as this week may be a rough week for the markets. The banking sector is taking a major hit, and unless something significantly positive happens in the banking industry, this is going to be a lingering issue now for a while. You have people scared at any bank right now, because whenever you see this happen at a major federally regulated bank, yet alone two, it's definitely something to be concerned about. The government has come out and said that they are fully, again, backing all the deposits from both of these banks. So everyone who has money in these banks is fine, and there will be no losses. Will most likely end up costing our taxpayers and government a couple $100 billion, most likely. But the question really remains, is this going to happen with other banks? And I think that's the major thing out there right now of uncertainty in the market, is if this continues. If we start seeing other banks this week getting nervous or reporting negative news in regards to this, market is going to be in some big trouble. So be on the lookout. Let's see what happens moving forward. That's all we can really do. Hopefully this is just a limited scenario where it was just these two particular banks, but the cream's going to rise to the top in this situation. We were just in a major inflation, and we're still in a major inflationary time. So the weakness of banks that took any risk during this time, it's going to show, just like it did with Silicon Valley Bank and Signature Bank here. the weakness will come through, the debt will rise to the top, they will not have the capital to cover it, and they will have to get bailed out. If this continues in an aggressive way with other banks and the government has to continue bailing them out, this is going to start costing a lot of money. And we've already spent $9 trillion in the past couple of years. Not a good sign. But I appreciate you all tuning in to this special edition. Good luck trading today. I will be on live as usual. And let's read these charts and see what's happening. Over and out. Take care.